And Chapter 4 deals with cost management systems and activity-based costing. And so once we finish Chapter 4, we should be able to describe the purposes of cost management systems, explain relationships among costs, cost objectives, cost accumulation, and cost assignment, distinguish between direct and indirect costs, explain the major reasons for allocating costs, and to identify the main types of manufacturing costs, including direct materials, direct labor, and indirect production costs. And these are all very important concepts from a management accounting perspective because they're fundamental to the discipline of management accounting. We're going to also talk about how financial statements of merchandisers and manufacturers differ because of the types of goods they sell. We want to understand the main differences between traditional and activity-based costing systems and why ABC systems provide value to managers. We'll use some examples of activity-based management to make strategic and operational control decisions, and then we'll describe the steps in designing an ABC or activity-based costing system, which is covered in Appendix 4. And so to support managers' decisions, accountants develop cost management systems, or CMS, collections of tools and techniques that identify how management's decisions affect cost. A cost management system provides cost information for strategic management decisions, cost information for operational control, and measures of inventory value and cost of goods sold for financial reporting to outside investors such as investors, creditors, or other external stakeholders. So when we think about a cost, we think about them as being a sacrifice or giving up of some resources for a particular purpose. And these particular purposes may be customers, service, departments, processing orders, or for the product, right? That's whatever a cost objective is. It's anything that's a separate measurement of cost. And so we may decide that, well, we want to collect cost and be able to report on them by customer, or by service provided, or by department, or perhaps by functional areas such as processing orders, or finally by product. And so when we talk about a cost accounting system, we're talking about cost accounting, which is that part of the cost management system that measures costs for the purposes of management decision making and financial reporting. So the cost data that managers use for decision making come from the cost accounting system, right? And which are the techniques used to determine the cost of a product, service, customer, or other cost objective that we just looked at. The cost accounting system is the most fundamental component of a cost management system. It supports all other cost management system tools and techniques. Cost accounting systems need to provide accurate and timely cost information to help managers make decisions. Without accurate and timely cost information, many decisions just can be downright harmful. And so here a simple illustration of these two basic processes for material costs. First, the system collects the cost of all materials. Then it assigns these costs to the departments that use the materials and further to the specific activities performed in these departments. Last, the system assigns the accumulated cost to the products made, such as cabinets, tables, or desks. The total material cost of a particular product is the sum of the material cost assigned to it in the various departments. For example, the cost of a finished desk would include the metal top, the sides, the legs produced by the various activities in the machining department, and the bolts, brackets, screws, drawers, handles, and knobs pieced together by the finishing department activities. Costs may be direct or indirect with respect to a particular cost objective. Accountants can identify direct costs specifically and exclusively with a given cost objective in an economically feasible way. Parts and materials included in a product are the most common types of direct cost. In contract, accountants cannot specifically and exclusively identify the amount of indirect cost related to a given cost objective in an economically feasible way. Examples of indirect costs include facilities rental costs, depreciation on equipment, and many staff salaries. And so when we talk about a cost allocation base, we're talking about some measure of input or output that determines the amount of cost to be allocated to a particular cost objective. And so for direct costs, the amount of costs that are attached to a specific cost objective are what is actually used in that cost objective. For an indirect cost, those costs have to be allocated based on some base, right? So because they cannot be easily and economically associated with a single cost objective like direct costs can be, so we allocate indirect cost based on a cost allocation base. So an ideal cost allocation base measures how much of the particular cost is caused by the cost objective. That is, there is a causal relationship between the base and the costs that are being allocated. Note the similarity of this definition to that of a cost driver, which is an output measure that causes cost. Therefore, most cost allocation bases are cost drivers. Cost allocations support a company's cost management system, which again we said is the system providing cost measurements for strategic decision making, operational control, and external reporting. And so here we talk about the four purposes of cost allocation. And again, they are to predict economic effects of strategic and operational control decisions, to provide some desired motivation and feedback for performance evaluation so that we can compute income and asset valuations for financial reporting, and to justify costs or to obtain reimbursement. And so a cost pool is a group of individual costs that a company allocates to cost objectives using a single cost allocation base. And the way to do that is to accumulate indirect costs for a period of time. We select an allocation base for each cost pool, which should represent a cost driver, that is, that it has some causal relationship. This base has some causal relationship to the pool of cost. We measure the units of the cost allocation base used for each cost objective and compute the total units used for all cost objectives. We determine the percentage of total cost allocation base units used for each cost objective, and then we multiply the percentage by the total cost in the cost pool to determine the cost allocated to each cost objective. And so this sounds more difficult than it is. Essentially, let's work through an example. We talk about something like fringe benefits. And so fringe benefits mean that's what you receive as an employee of a company that are in addition to your pay. So it's perhaps your medical insurance, the taxes, your long-term disability, vacation, fringe, or salaries. And so if we talk about all of those types of additional benefits to work for the company, and then we have a cost associated with those, and they go into this idea of a cost pool, and then we decide, well, what's the driver of that? Well, how much those costs are usually relate to how many employees I have and what my total wages and salaries are. And so suppose that I have $500,000 worth of fringe benefit costs, and I have $1 million worth of salaries and wages. So my cost pool is the $500,000 worth of fringe benefit cost. My cost base, or the driver of those, are total salaries, or $1 million. So my base pool divided by my base gives me a 50% fringe rate. And then so I'm saying for every dollar of direct labor that I have on a project, which is the direct cost we talked about earlier, I have a 50% fringe loading, or 50% indirect cost that I'm also applying to that product. And here we're just finishing up with the steps that we talked about earlier. So a cost pool, as we said earlier, is a group of individual costs that a company allocates to cost objects using a single cost allocation base. So again, we accumulate the indirect costs for a period of time. We select the allocation base. We measure the units of cost allocation base for each cost objective and compute the total units used for all cost objectives, and we multiply the percentage by the total cost in the cost pool to determine the cost allocated. And what we're looking at here is, again, this idea of the costs that are attached to these cost objects to the right there, such as product, service, customers, are a function of the direct costs, which we can physically track and attach to products, such as the material that goes into it, the button bolts and screws and nuts and brackets that are used, plus these indirect costs. And our example before was fringe costs. So these indirect costs that we allocate to them because it's not economically feasible to try to break those down and attach them the way we do direct costs. So we allocate them using this cost allocation base, which essentially should represent a cost driver, which gets us the causal relationship between the base and the cost, the indirect costs themselves. And so some costs lack an identifiable relationship to a cost objective. And so where we have this, it is best to leave these costs unallocated. An unallocated cost for one company may be an allocated cost or even a direct cost for another. Unallocated costs are recorded but not assigned to any cost objective. And so unallocated costs still impact our net income. They still show up on the income statement, and they are still an overall cost to the firm. It's just that either we can't create this causal relationship to get a base against which we can allocate these costs, or it's just not feasible to do that if we look at it from a cost-benefit standpoint. And you recall we talked about cost-benefit earlier in the year. So here what we're looking at are the direct, indirect, and unallocated costs for Lee Company. So if we consider the statement of operating income for Lee Company in Panel A of Exhibit 4-3, Lee Company makes cabinets, tables, and chairs. Each item in Panel A represents accumulated costs for all products sold for an entire operating period. To help make a strategic decision regarding which of the three products to emphasize, it would be useful to unbundle these total costs to find the profitability of each product. And then we say, well, how can we do that? We consider the cost of goods sold, which includes all manufacturing costs. Like most companies, Lee Company finds that it is easy to trace direct material costs to individual projects. However, other manufacturing costs are difficult to trace directly, so Lee Company treats them as indirect and allocates them to products. So manufacturing companies accumulate and report the cost of inventories in a different way than merchandising companies. Manufacturing operations transform raw materials, which are the basic materials from which a product is made, into other goods through the use of labor in factory facilities. In manufacturing companies, products are frequently the cost objective. Manufacturing companies classify production costs as either direct material, direct labor, or indirect production costs. And so if we talk about direct material cost, these include the acquisition cost of all materials that a company identifies as a part of the manufactured products and that it can trace to the products in an economically feasible way. Examples are iron casting, lumbers, aluminum sheets, and subassemblies. Direct materials often do not include minor items such as tacks or glues because the cost of tracing these minor items is greater than the possible benefits of having more precise product cost. Such items are often called supplies or indirect materials, and they are part of the indirect production cost. Direct labor costs include the wages of all labor that can be traced specifically and exclusively to the manufactured goods in an economically feasible way. In highly automated factories with a flexible workforce, there may not be any direct labor costs, because all workers may spend time overseeing numerous products, making it economically infeasible to physically trace any labor costs directly to specific products. Manufacturing overhead includes all costs associated with the production process that the company cannot trace to the manufactured goods in an economically feasible way. Examples of these indirect production costs are power, supplies, supervisory salaries, property taxes, rent, insurance, and depreciation. Supplies or indirect materials are also part of indirect production costs. Supplies are materials used in the manufacturing process that do not become part of the product, such as sandpaper or cleaning materials. Minor items such as tacks or glue are also often treated as indirect materials, even though they become part of the manufactured product, again because the cost of tracing these items is greater than the benefits of having more precise product cost. And what did we refer to this as earlier, this analysis? The cost-benefit analysis, right? The cost of tracking them is not worth the benefit of having more accurate product costs for these minor immaterial supplies. Similarly, accountants consider many labor costs, such as costs of janitors, forklift truck operators, plant guards, and storeroom clerks, to be indirect labor because it is impossible or economically infeasible to trace such activities to specific products. And so product costs are costs identified with products manufactured or purchased for resale. In a manufacturing company, product costs include direct materials, direct labor, and indirect production costs. These costs first become part of the inventory, thus we sometimes call them inventoriable costs. These inventoriable costs become expenses in the form of cost of goods sold when the company sells the inventory. So these product costs, right, versus the manufacturing cost, okay? In contrast, period costs become expenses during the current period without becoming part of inventory. Period costs are associated with non-production value chain functions such as research and development, design, marketing, distribution, and customer service. Accounting information systems accumulate these costs by departments such as R&D, advertising, and sales. Most firms' financial statements report these costs as selling and administrative expenses. In short, these costs do not become a part of the reported inventory cost of the manufactured products for financial reporting purposes. And so this exhibit illustrates product and period costs. The top half shows a merchandising company such as a retailer or wholesaler that acquires goods for resale without changing their basic form. The only product cost is the purchase cost of the merchandise. The company holds unsold goods as merchandise inventory and shows their cost as an asset on the balance sheet. As the company sells the goods, their costs become expenses in the form of cost of goods sold. A merchandising company also has a variety of selling and administrative expenses. These costs are period costs because the company deducts them from revenue as expenses without ever being regarded as a part of inventory. The bottom half of the exhibit 4-4 shows product costs and period costs in a manufacturing company. Note that the company transforms material costs into saleable items saleable items with the help of direct labor and indirect production costs. You can see that the balance sheets of manufacturers and merchandisers differ with respect to inventories. Instead of one inventory account, a manufacturing concern has 3 inventory accounts that help managers trace all product costs through the production process to the time of sales. These accounts are shown as either direct material inventory, work in process inventory, or finished goods inventory. Manufacturing inventories are usually composed of these three major categories. Again, raw materials, work in process, or finished goods. Merchandise inventories are usually composed of the purchase cost of items, including freight in, that are acquired and then resold. And here we see just the difference between the current assets section of the balance sheet for a manufacturer versus a retailer or wholesaler. The differences between the balance sheet of a manufacturer and that of a merchandiser, such as a retailer or wholesaler, is apparent from the inventory accounts from this example of a 2009 annual report of Cisco Systems and Costco Wholesale. Right, so for Cisco, we see the different types of inventory accounts we talked about: raw materials, work in process, or finished goods, which total 890, most likely million, versus Costco, which doesn't really make anything. They buy and resell, right? So they have merchandise inventory totaling 5,405. And so this illustrates product and period cost. Again, the top half shows a merchandising company, such as a retailer or a wholesaler, who acquires goods for resale without changing their basic form. The only product cost is the merchandise cost of the merchandise. This bottom half shows a manufacturing company. Note that the company transforms direct materials into saleable items with the help of direct labor and indirect production costs. We can see that the balance sheets of the manufacturer and merchandisers differ with respect to inventories. Instead of one account, as we saw earlier, a manufacturing concern has three inventory accounts, that is, direct material, work in process, and finished goods. And so the manufacturer's cost of goods produced and then sold is usually composed of these three major categories of cost: direct materials, direct labor, and indirect manufacturing. On the other hand, the merchandiser's cost of goods sold is usually composed of the purchase cost of items, including freight in, that are acquired and then resold. They aren't broken down into, on a merchandiser's cost of goods sold, they aren't broken down into the different components such as direct materials, direct labor, and direct manufacturing. And so manufacturing costs of goods produced and then sold usually composed of the three major categories: direct material, direct labor, and indirect production costs, which we see on the left-hand side here. Right? The merchandiser cost of goods sold is usually composed of the purchase cost of the items, right, plus freight in or other costs that are then acquired and then resold. So again, we can kind of see the difference here in the sections of the income statement between a manufacturer, a retailer, or a wholesaler. So there are many different types of cost accounting systems, but most of the important features of these can be described in terms of two general types: traditional or activity-based cost accounting systems. Companies adopt cost accounting systems that are consistent with their management philosophies and their production and operating technologies. That is to say, there's no absolute right or wrong system to adopt. It depends by company. And again, we talk about their philosophies or their production and operating technologies. Changes in philosophies or technologies often will prompt corresponding changes in the cost accounting system. And so what we can see here is that until the 1990s, almost all U.S. companies use traditional costing systems. That is, those that do not accumulate or report costs of activities or processes. Traditional costing systems often use a single cost pool for all indirect production costs, with labor costs or labor hours as the cost allocation base. And you recall earlier we talked about this idea of a cost pool and a cost allocation base and the necessity that there be this causal relationship between the two. Such traditional systems work well with simple production processes. Consider a company that makes only a few products for which direct material and direct labor costs are a high percentage of total cost. Indirect production costs are a small percentage of total costs, so the system combines them into one cost pool and allocates them to products using only one cost allocation base, such as direct labor hours. Such a company can achieve a high level of accuracy of product costs with the traditional costing system. So this exhibit shows the company's traditional cost accounting system in Panel A and the related two financial reports for the most recent quarter in Panel B. And so to the left we see the total sales of $440,000, direct materials of $34,500, direct labor of $150. We work down to a gross profit of $35,500 with corporate expenses of $100,000, resulting in an operating loss of $64,500. Out to the right, we see these amounts broken down based on different products, such as pen casings or cell phone casings, right? The traditional costing system traces the direct materials and direct labor costs to these products. And we also note that the three types of costs include direct, indirect, and unallocated. And so alternatively, if we don't use this traditional costing approach, we can use what we call an activity-based costing system, or ABC system. This achieves a high level of cost accuracy in an operating environment which requires this. And this really represents a more elaborate cost accounting system. The system that first accumulates, it is a system that first accumulates indirect resource costs for each of the activities of a particular plant, department, or value chain function or organization, and then assigns the cost of each activities to the product, services, or other cost objectives that require the activity. Most ABC systems provide highly accurate product or customer costs that a company can use for strategic decisions. Further, information about the cost of activities helps managers to understand the cause and effect relationships between day-to-day activities and product or customer costs, and thereby aids the operational control purpose of cost management systems. Many managers believe that ABC systems help them better manage their organizations. Exhibit 4.7 here depicts and illustrates a two-stage ABC system which uses two stages of allocation to get from the original indirect resource cost to the final product or service cost. The first stage allocates indirect resource costs to activity cost pools, in this case two activities, the processing activity and production support activity. The second stage allocates activity costs to the products or services. In essence, the cost objectives in the first stage are the activities, and the cost objective in the second stage are the products. Activity-based management, or ABM, is using the output of the activity-based cost accounting system to aid strategic decision-making and to improve operational control of an organization. One of the most useful applications of ABM is distinguishing between value-added and non-value-added costs. A value-added cost is the cost of an activity that a company cannot eliminate without affecting a product's value to the customer. Value-added costs are necessary as long as the activity that drives such cost is performed efficiently. In contrast, companies try to minimize non-value-added costs, that is, costs that a company can eliminate without affecting a product's value to the customer. Activities such as handling and storing inventories, transporting partly finished products from one part of the plant to another, and changing the setup of production line operations to produce a different model of a product are all non-value-added activities. A company can often reduce, if not eliminate them, by careful redesign of the plant layout and the production process. And so another ABC-related technique is benchmarking. That is the continuous process of comparing products, services, and activities to the best industry standards. Benchmarking is a tool to help an organization measure its competitive posture. Benchmarks can come from within the organization, from competing organizations, or from other organizations having similar processes. And so here we can just see a couple of the benefits of activity-based costing and management systems, such as helping us to set an optimal product mix, to helping us to better estimate profit margins of new products, to better determine consumption of shared resources, and to keep pace with new product technologies. Keep in mind, though, that as we are able to recognize these improvements and these more accurate costs, there is a cost that comes along with them. And so we get back to that old topic that we talked about earlier, this cost-benefit relationship. Additional benefits might include keeping pace with technological changes, decreased costs associated with bad decisions, or to take advantage of reduced cost of ABC systems due to computer technologies. And so this exhibit depicts the residential and commercial customer classes, which essentially become the cost objects, and the resources used to support the billing department. All of the costs incurred in the billing department are indirect. There are no direct costs or unallocated costs. The billing department currently uses a traditional costing system that allocates all indirect production costs based on the number of account inquiries. And so this is just an illustration of the design of the traditional costing system that we might see, out in any company. And so the key components of an activity-based cost accounting system are cost objects, key activities, resources, and related cost drivers. These components, together with the purpose of the new system, determine the scope of the ABC system. And so the four key billing department activities are account billing, bill verification, account inquiry, and correspondence. These activities require the vast majority of the work done in the billing department. There are other activities performed in the billing department, such as routine printer and computer maintenance, training, and preparing monthly reports. Then we allocate the cost of the 5 activities to the 2 customer objects, residential and commercial. For example, commercial accounts require account inquiry, correspondence, billing, verification, and other activities. We allocate the activity costs based on a measure of the amount of activity that each customer uses. For example, we allocate the account inquiry activity cost pool based on the number of inquiries received from residential and commercial customers. And so in step 2, we perform an analysis of interviews with supervisors from the billing department. An important phase of any activity-based analysis is identifying the relationships among key activities and resources consumed. The management team does this by interviewing personnel and analyzing various internal data. In step 3, we collect the relevant data concerning cost and the physical flow of the cost driver units among resources and activities. And then in step 4, we calculate and interpret the new activity-based information that is different from the traditional costing method that we saw early on, and we determine the traceable amounts for each activity of the cost pools, and then we determine the activity-based costs per account for each customer class. Billing department managers can use the ABC system to improve their strategic decisions and operational cost control. Suppose that the billing department needed to find a way to increase its capacity to handle more accounts due to an expected large increase in demand from a new housing development and a business center. Managers propose strategic actions, perhaps outsource certain customer accounts to a local service bureau. Billing department managers are also interested in reducing the operating cost of the department while not impairing the quality of the service it provided to its customers. To address both of these issues, they use the ABC information to identify non-value-add activities that had significant cost. Account inquiry and bill verification activities are non-value-added and costly, so management asks for ideas for cost reductions to improve strategic and operational decisions. And so here's some more information regarding the number of cost driver units for the billing department. And again, this information would come out of a review of historical information, and it would come out of a review of interviews with departmental staff. And so now management can use the completed process map to determine costs for the strategic and operational decisions that they must make. And that's what we see here. It's really the culmination of all of the research and all of those steps that we just talked about. And then finally, we're able to develop this mapping of the 5 activity cost pools, that is account inquiry, correspondence, billing, verification, and others. So based on all of the activities and steps we just talked about, we can take their total cost, which amounted to $687,500 in that first column, and then allocate that out across the different activities that are involved in that, such as account inquiry, correspondence, billing, verification, and others. And then, based on a cost base, assign each of these activity cost pools as a cost to a particular cost objective. But you can see that it's based on, and the key here is that these costs are based on activities. So if a particular cost objective doesn't participate in certain of these cost activities, they don't ever receive an allocation of cost associated with it. But again, I think you can get an appreciation for the level of complexity and the cost that it takes to get to this level of detail. And so this completes Chapter 4. So please go back and reread the chapter. It's a complicated chapter, and I know that it talks about and includes a lot, but it's an important chapter because it lays the fundamentals with respect to cost pools, cost basis, cost allocation, direct versus indirect cost, difference between manufacturing versus merchandising, the different inventories and what are included in them. There is a lot there, so I encourage you to go back and make sure you're comfortable with it, and then proceed on to the discussion forums and the learning exercises. And so thank you very much, and I'll look forward to talking with you again when we cover the information in Chapter 5.